All right. Assalamu alaikum, everyone. Apologies for that. This is a series of webinars that we host every fortnight. This is the one about what is Islamic finance all about. And we have Dr. Mahmoud Nafi, who's a lecturer and a researcher at the Center for Islamic Thought and Education here at the University of South Australia, who will be presenting on this topic. So over to you, Doctor.
Jazakallah, Ramila. Assalamu alaikum, everyone, and good morning. Thank you so much for attending this webinar. I am going to start off by quickly going through the session format. And as you can see there, I'm saying that this is probably unfamiliar territory to a lot of you people. Of course, if you are familiar with Islamic finance, alhamdulillah, that will be a plus. But in going through this, my intention is to keep this whole series of lectures that I intend to present on Islamic finance. Just want to keep it very simple and understandable so that everyone has an appreciation of what Islamic finance is all about. And the objective, of course, is just to become familiar with this term, Islamic finance. It's sometimes very difficult to visualize or to understand when you read it in the press or on a website or anywhere that you can sort of get information on. I want to just throw light on what this whole idea of Islamic finance is about. And I suppose in doing that, I want to bring out the subtleties of this idea of Islamic finance, what exactly it is, what is it that they are portraying, what are their objectives, and how do they go about achieving those objectives. There you can see this is not a problem for myself only, because I keep on learning every day all sorts of new things that are happening in the industry. And let me tell you, it's a very daunting task because there's so much coming onto the market on a daily basis, and to keep up with the development on market is quite challenging. I just want to take you back very briefly on a few years ago, if you recall, in the 2008, 2009 collapse, the global financial crisis. You know, everyone was worried about what's going to happen to banking. And surprisingly, the Western banks found that the Islamic banking sector was doing quite well, in the sense that they were not exposed that much to all the risk exposure that the conventional banks were exposed to. So there you can see this little chap saying no interest. I'm not losing interest. The culmination of all this was that there was a refocusing on how Western or conventional banking can learn from Islamic banking. Of course, one of the fundamental issues that distinguishes Islamic from non-Islamic banking is this idea of no interest, and the West find it rather difficult to conceptualize how banks can function without indulging in interest. So very briefly, I listed a few points here on where the difference is between Islamic and non-Islamic banking. I will constantly refer to non-Islamic banking and also conventional Islamic banking, which is actually the same thing. It is faith-based, first of all. It is based on Quranic and Hadith and other principles. And we find that these are very, very well entrenched in the Quran and in the various jurisprudential writings. Now, today I want to focus specifically on the issue of interest, because it is at the core of Islamic finance. And I don't want to muddle the waters by introducing too many topics. So I'm going to concentrate only on a few topics. within Islamic finance so that we can go through this gradually and you can have a good grasp of the subject matter. And then probably on a fortnightly basis to build on what I've said the week before and then to cover the whole spectrum of Islamic finance. Now, Islamic finance, very shortly, is premised on the lawful versus the unlawful, the lawful versus the prohibited. And of course, in that spirit, it delineates financial transaction into what is ethical and what is not ethical. And of course, the whole concept of Islamic finance is premised on contracts, legal contracts. Let me explain. When you and I walk into a supermarket and we buy an item off the shelves there, we are actually entering into a contract. The supermarket is displaying goods there, and we go and take the goods, and if the price is, um, if we are satisfied with the price, we go and we pay for the goods. So we have tacitly entered into a contract. We see the goods, there is a price, we like it, we pay for it, the transaction is completed. So contractual obligation under Islamic finance is very, very important. Having said that, let's go through a few of the key principles that underlie Islamic finance. There you see in this um, in the slide here that there are 6 very important elements that constitute Islamic finance. I'll start off from 12 o'clock, which is no haram elements, and then work clockwise to the others. No haram elements means that Islamic finance is premised on everything that does not admit any haram activities or in indulgence in the transactions of those activities. For example, you cannot go and buy stocks on the stock exchange that indulges in, let's say, alcohol or gambling or prostitution or things of that sort. No interest is what we're going to cover today, and I'll leave that one for the time being. And then these other 2, no gambling and to avoid uncertainty, I'm going to cover next week. But very briefly, Islamic finance does not admit transactions or activities that come close to or resemble gambling, in a sense that one cannot take a bet on any transactions. If I enter into a transaction with you, that transaction must be premised on some contract. Now, as you know, gambling is contractless. In other words, you take a bet, and if the bet works out, you win. If the bet doesn't work out, you lose. In the nature of things, gambling always works the opposite. You hardly win, and if you do, it's a chance. And this is why we come to the next one, which is the avoidance of uncertainty. Of course, we cannot say that uncertainty does not exist. It does exist, because imagine if you walk into a into a fruit shop and you buy a watermelon. I mean, you're not absolutely sure whether that watermelon is ripe or not ripe. So these are what we call natural uncertainties. They occur there by virtue of nature. But uncertainty in a financial world works quite differently. I'm going to leave that for the next lecture that I'll be presenting, inshallah. And of course, this is the essence of Islamic banking, that all the banking is based on real assets. In other words, it's not fictitious assets like delving or participating or buying derivatives, for example, buying options or derivative contracts. And of course, Islamic finance also says that if you enter into transactions with other people and it is for profit, then you and the other parties must accept that there will be risks involved. And as a result of sharing those risks, you and the other party accept that there may be a profit or there may be a loss, in which case, in both circumstances, you will have to share the profit or the losses, depending, of course, on how the partnership is structured. Very quickly, I'll go through where Islamic finance began. Dr. Ahmed Al-Najjar, a very, very prominent scholar who is still alive, and he's very much involved in a very big company, and he was instrumental in forming a little cooperative in a place called Mount Midkimer in Egypt, which is about 90 kilometers from Cairo. And in that place, he noticed that there were a lot of poor farmers, and these poor farmers were finding it very difficult to buy equipment and seed and so forth. And he said, look, why don't we get together and we pool our resources and we invest this money into some productive way, and whatever profits we realize, we share it amongst ourselves. And his pioneering work really worked in that particular place in Egypt, and it gained a lot of currency very, very quickly because everyone was very excited about the concept and its benefits. It quickly grew to about 8 other similar investment schemes, and having the change in political in politics in Egypt when Nasser came into power. Nasser was very interested in what was happening on the ground, as it were, and he quickly nationalized this this organization, or this so-called mini Islamic bank. It wasn't really a bank, it was just a loose cooperative. Nasser, of course, had other intentions, and what he did was he then uh, converted that organization into the Nasser Social Bank. It was by chance that Nasser happened to be there when all this was going on. Unfortunately, Nasser relegated its status because when they converted this into the Nasser Social Bank, it lost its Islamic flavor because its constitution did not mention anything about Sharia or Islamic law. Very quickly, in 1963, shortly after Malaysia gained independence, the government there realized that people had a lot of money, required a lot of money for the Hajj. And so the government put together a scheme whereby people could deposit their little savings every week or every month and so forth into an organization called Tabung Haji. And this very quickly grew into a massive organization which still exists today and doing alhamdulillah, a lot of good work. So these are two of the early pioneers. And then quickly it translated into the corporatization of finance, with the first one established Dar al-Mal in Geneva by Sheikh Yamani, if you recall, shortly after the war with Israel in 1973. Sheikh Yamani was very instrumental in there, and because of the increase in the price of oil, he then set up this organization, Dar al-Mal Islami. What's interesting is that he couldn't do that in Saudi Arabia itself because the government there were not very receptive to the idea. And so he set up this organization in Geneva. And then this was followed very quickly in 1975 with the development of the Islamic Development Bank, which was Saudi-based, and it was meant to be a multi-state bank to help less developed Islamic countries that belong to the OIC. And then we have a series of developments from 1975 onwards that culminated in a rapid development of Islamic finance from there on. But what really set this whole pace was a very important piece of work by Dr. Najatullah Siddiqui, who was based at Aligarh University in India, and he wrote a very seminal work called Banking Without Interest. And there he set out the fundamentals of Islamic finance. Of course, these fundamentals had to be revised because a lot of his ideas did not fully encompass all the values encompassed in Islamic law. But the point to remember is that he was one of the first pioneers who wrote extensively on Islamic banking. And then, of course, this spread quickly to Malaysia, where a lot of the activities related to Islamic banking took hold. And there, especially in Malaysia, was the creation of the Bank Islam Malaysia Berhad, which was the first fully fledged Islamic bank in the world. Quickly, the basics of Islamic finance, as you can see there, I'm not going to read through it, but Allah subhanahu wa ta'ala says in the Quran, and I'll come to that verse of the Quran, says that trade is encouraged and riba is discouraged. And in the whole scheme of things, in an economic sense, money is a mere means of exchange. Money cannot be a commodity like fruit or a cow, anything of that sort, because it is merely one where you pay for something and in return you get goods or services. And as an incentive for engaging in trading, the person who is in charge or who owns the assets that has to be sold can either profit or he can lose by way of sales or selling. Then, of course, there are other ethical issues related to trade as well, whether that trade falls into the category of what is halal or what is haram. And Islamic finance, and this one is very important, debt versus equity. Debt meaning that Islamic finance is not based on debt. Debt meaning money lending. So if I go into an Islamic bank and I say, can I borrow $100,000? They say, thank you very much. We don't lend money, but we will finance it on the basis of equity, meaning that we will enter into some form of a transaction whereby we will put up the funding, we will buy the asset and we'll send it to you on a partnership basis. So these are some of the very essentials of Islamic finance. And then I ask the question, is Riba the only, is Islam the only religion that prohibits Riba? And we see that in Jewish and Judeo-Christian teachings that up until the Council of Nicaea, the Catholic Church actually condemned the practice of usury and condemned it to the extent that if you were caught indulging in usury or usurious transactions, the punishment would be death. So at that time in the Christian era, the church took a different course when Protestantism entered into Christianity in Europe. And John Calvin, who was one of the leaders in the Protestant movement, actually broke away from the Catholic Church. And one of the issues he was concerned was the strict prohibition of interest. And I'm not saying that that was the only reason, but that was one of the many reasons he broke away from the Catholic Church. And interest was in the Catholic teaching was called interest or usurer. And of course, as I said earlier, it was strictly prohibited. Over the centuries, of course, it gradually conceded that its stance on interest was very, very harsh, and it started loosening the conditions under which transaction could be entered into under the guise of interest. So we have the position today where a lot of the interest-bearing activities that conventional banks engage in were actually the culmination of um, activities within the church that gradually allowed the introduction of interest within um, within the religion. However, we must understand that there were specific prohibitions, especially in the Bible, especially in these verses here, Exodus, Leviticus, and especially this one here, this book here, Deuteronomy, where it was specifically banned, and it was banned only to the extent that you couldn't enter into usurious transaction, but Jews could enter into a transaction within them, between Jews and non-Jews. Anyway, our focus is on Islamic finance. There you can see in this slide here that there was the very famous incident where Jesus, Isa alayhi salam, went into the temple in Jerusalem, and he found that the money lenders were very active in the temple itself. And he said, how could this be that the very religion that prohibits interest is now being converted into a usurious place? And so he cast the money lenders out from them. Then a series of developments happened within the non-Islamic finance industry, especially with John Wesley, who was the founder of the Methodist Church, who was an avowed Christian, but who also was very conscious of the difficulties that the poor and the indigent people of the UK were experiencing, especially in housing, because housing was controlled by the landed aristocracy in the UK, and still does to a very large extent. And so he said that the only way we can bridge the gap between the rich and the poor was to open up the market, as so to say, so that people can engage in buying homes without the problem of paying a harsh interest on loans. And the Quakers had the same philosophy. To interest itself, what is interest and what do we mean by interest? Within the within the literature, we can distinguish various explanation about what interest is. One is growth or accretion or an increase, but a growth without effort and a growth where one person puts in money and it grows without a counter value coming from that person. In other words, I lend you money, $1,000, and without putting in any effort, I get back a thousand plus $100. In other words, I haven't done anything. I've just lent money to you, and you've repaid the money at principal plus interest. This is what we call unjustified earnings, and it is also called unjustified advantage, because as long as the lender is in a position whereby he or she can dictate to the borrower, there will always be an unjustified advantage given to the lender. So it does not matter whether the money was given to encourage consumption, in other words, to buy a car or to buy a machine or anything of that sort, or whether it was to give money to buy food for that matter. And it's also, it doesn't matter really how that loan is couched, whether it is couched in legal terms as a mere loan or just as a credit like we have with credit cards today. So riba is the word that comes up in Islamic law, and it is also mentioned in the Quran in 4 places. It means excess or surplus over and above the loan capital, and it is time-based. In other words, um, I lend you $1,000 today, and I say to you, repay me after 6 months. The fact that I'm giving you time, I'm adding something to the time which makes it usurious in the sense that I will expect that giving you this 1,000 now, because I'm going to lose something in the meantime, I'm going to charge you interest. So it is based on the theory that there is a time value of money, which is a concept that I can speak on for hours and hours, but I'm not going to go into that now. The point to remember is that if you express this intention when you make a contract or when you give the money, it is made a condition of a contract, and to that extent, it is expressly prohibited in the verse in Surah Baqarah, which I'll come to. Yeah. So, where did the prohibition come in relation to riba in Islam? As you would understand, it came in very gradually, just like the prohibition of alcohol came in very gradually. So the first stage was in Surah Rum, where Allah subhanahu wa ta'ala morally denounced the prohibition of riba. And then in the second stage, where riba was specifically mentioned that it is unethical, you should remember that before Islam, the Arabs in the Arabian Peninsula were very active traders. They were very, very active in trading goods that were coming from Africa and that were being siphoned, or the trade routes uh, went from Africa through Arabia, through the Arabian Peninsula, and into what is called Sham today, or Iraq, Iran, and those places, and of course further east to China. So the practice in pre-Islamic time was riba was very rife, and riba was practiced in the sense where the loans that were given by traders to other traders was sometimes double and redoubled, and Allah subhanahu wa ta'ala specifically prohibited that in the next stage in Surah Al Imran. And the last stage, and some of the scholars of the interpreters of the Quran, uh, they they say that probably this was one of the last verse that was revealed to the Prophet himself, and it dealt specifically with the prohibition of riba. And in that verse, Surah Baqarah 275 to 81, there's a lot of conditions in that. And I've just briefly summarized them. It says Allah subhanahu wa ta'ala allowed trade and prohibited riba. It is better to give, there's a spelling error there. It is better to give than to demand unjust enrichment. And a creditor must be paid what is due to him or her. So if I've given you money, if I've lent you money, then give it back, but without interest. And if somebody owed you and was not in a position to repay that money, then that person should be given time to repay the money, or if under such circumstances that the debtor was unable to pay it, then to say, I will this thing, uh, I will forgive you the debt. So we see here that the last revelation in Surah Baqarah is the one that we use currently in Islamic finance, and on which this whole concept of Islamic finance is justified. This particular verse, these particular verses, sorry, 275 to 81, is has got tremendous impact on what we can and what we cannot do within Islamic finance. Then we come to the types of riba that are prohibited, and there are two types: the riba that occurs in loans and a riba that occurs as a result of selling something. The first one is riba qard, something that you give, but you expect something in return. And the second one, riba jahiliya meaning the riba that was practiced during the time, during pre-Islamic times. Now, both these types of riba deals with money lending, pure and simple. The other two deal with riba that occurs in financial transactions, in sales transaction, in the exchange of goods and in the exchange of services. And I'll give you examples of those. Here, the type of riba al-fadl and riba al-nasiya, I'll just quickly go to the next slide. So here we are. The first one is riba of duyun, or riba of debt. I lend money at $100 and I expect 10% return. And the interest must be paid upfront. In other words, here's $1,000, here's $10,000, but you must give me the interest now. And the repayment is deferred. The next one is riba jahiliya, meaning that you have to pay me the principal plus the interest at the end of the contract. So if I say to you, here's $1,000, pay me after 6 months, and after 6 months, I expect you to pay me $1,000 plus 10%. Now, what happens if on that due date, if it's not paid, then what was happening in the days of Jahiliyyah was that the creditor will go to the debtor and say, okay, you haven't kept your part of the contract, so now I'm going to redouble the amount. I gave you $1,000, now you owe me $2,000. And this was specifically prohibited in the verse in Ali Imran that Allah subhanahu wa ta'ala says, do not take riba double and redouble. Many scholars have given a wrong interpretation of this, saying that yes, riba is allowed, but only you shouldn't double it and redouble it. But that, of course, is a scholarly debate, and we're not going to go into that. The second one is the exchange of goods. So in Islamic law or finance, the fundamental principle is that if I exchange, let's say, 1 kilo of rice, then I must exchange it either for money, because money is a medium of exchange, or if I'm going to exchange it for some other type of rice, then we must value that other type of rice in terms of money and then conclude the deal. We cannot say, okay, here's a kilo of basmati rice, for example, and I'm going to change it for 1 kilo of some other rice, scented rice. And the condition is that if you do engage in such activities, then the activities must be spot. That means the terms of condition, the terms of exchange, plus the price, plus the delivery must be made at a spot at which the transaction is occurring. In other words, if you go into Coles or Woolies and you buy a kilo of sugar, for example, you're buying it at spot exchange. You've taken delivery of the sugar and you've paid for it immediately. Riba Nasiya is deferment of exchange. In other words, I give you uh, uh, goods now, but I expect more of the goods later on. Not in the form of the same goods, but in terms of money that is which constitute the value of the goods. Now, the other elements of riba was something that occurred during the time of the Prophet ﷺ, when he, in the last sermon, gave the condition that whoever is owed money and that money was not paid, that the person who was owed the money must be repaid. And if that was not done, then it must be repaid without interest. And then he referred to his uncle and he said that this uncle of mine, his loan that he's given to all of you is not going to incur any interest. And so this was specifically prohibited, but the Prophet ﷺ himself made very clear at the Hajj al-Wida that no more shall there be interest or usurious transaction. There are other views about whether one can indulge in interest-bearing transaction. I'm going to deal with this in a later lecture, but just very quickly, there was a fatwa issued by the European Council of Islamic Scholars, and they came to the conclusion that because of the difficulties that were faced by Muslims throughout the world, especially with Muslim minorities like in Australia, that under certain circumstances, and the circumstances were clear and were very, very express, that yes, one can buy a house if the conditions necessitated and there were sufficient reasons that qualified that person to engage in such usurious transaction. And here it says that it is based on these reasons that the necessity turns unlawful matter into lawful. For example, you may go to a clinic or the hospital, and the hospital will say that we're going to administer this medicine to you, but the medicine is derived from, let's say, a pig. For example, insulin that a lot of people take for their diabetes, a lot of the old insulin was extracted from the gut of the pig. And so this Islamic rule or the is comes into play here. That the necessity turns lawful unlawful into the lawful. Of course, it is not to be applied very, very easily. It's very, very specific, and it applies to specific circumstances and to specific people. And of course, there are other conditions of hajah, which is need or necessity, and darura, which is extreme necessity. So these two conditions are used extensively in very limited circumstances where it is absolutely necessary. For example, let's say a lady who does not have a husband and she has, say, 5 or 6 kids, and now she's experiencing severe hardship as a result of a landlord that is being hard, then the scholars have said that under those circumstances, the plight of that lady is one that requires or is one under which that attracts extreme necessity. So if she doesn't have a house, that means she and her children will be left out on the street, as it were. So under those particular circumstances, there is play, or there is room for maneuverability for this relaxation of the strict prohibition. But I don't want to really cloud the issue now. I really want to um, focus on what riba is. And in later lectures, inshallah, I'll go into the depth of what is meant by darura and haja and so forth. And at that time, we can then discuss in detail what type of housing loans are permissible and so forth. At this stage, I just want to keep it very, very simple and take this whole discussion of Islamic finance gradually, piece by piece, so that you can appreciate the constituent parts of Islamic finance gradually, understand it, and if you don't understand it, get back and so forth. So it's a long but fruitful, inshallah, process or learning curve. And I hope by the end of whatever 10, 15, 20 series of lectures, you would have had a sufficiently good grasp of what Islamic finance is all about. I'll go back to Ramila and I'll invite people to ask any questions if you have. And I will make these slides available to you. Hopefully, if you have any questions, you could put them to me specifically. If not today, probably as we migrate to other. Now, from here on, I'd like to mention that this series of lectures comes to you from the University of South Australia. Our center is called the Center for Islamic Thought and Education. We will be presenting a number of very thoughtful webinars over the coming months. I certainly am going to continue with this theme of Islamic finance. And we also offer within the center a number of courses in Islamic finance, other minors like Islamic law and 4 other courses. So I encourage you to stay in touch with us. Here's the website here. You can either contact us on our website here, contact Ramila, contact myself, and any of the other scholars. Thank you so much. Assalamu alaikum.
Assalamu alaikum, everyone. Thank you. Sorry, thank you, Dr. Mahmoud Nati. I've got a question here that was posed privately. If anyone else has questions, can you please put it in to the chat? So I'll go with the first one, Dr. Mahmoud. It asks, in reference to Islamic mortgage in specific to Ijara program offered by multiple Islamic finance company, does the interest-based source of funds for the lender make it halal for us to use that?
Thanks. It is a very interesting question. And I said specifically, I'd like to deal with it, on an occasion when I do a lecture on housing finance and especially Ijara finance. This is not a question that I can give you an answer to in a minute or so. It requires a lengthy explanation. However, having posed this question, my answer would be that there are 4 or 5 institutions in Australia today that do Islamic financing based on ijara contracts. And the reason they do that is that because legally it's very difficult for those institutions to um, uh, to contractually enter into a transaction of home loan financing because they are not recognized as financial institution or what we call ADIs, authorized deposit institutions. As a result of which they cannot, by virtue of their charter or the conditions under which they are incorporated, enter into what is specifically banking related transactions. That's number one. Number two is where they get their money from is a debatable question. Now, if I enter into a contract with you and I said to you, can you give me $10,000? Prerogative to ask you, where do you get your money to give me, to lend me money? That has nothing to do with you. So the question here is, does the source of money that these institutions, I call them institutions, they're not really institutions, they are mortgage brokers really, because they are just in go between the banks and the end user, which is the borrower. I specifically want to deal with this in later lectures, and I want to go through using examples which I can upload on a spreadsheet and show you precisely how it is that that these loans are structured and why they are, why some of them. Hello. Yeah.
Yeah, I can hear you.
Yeah. So please bear with me. The short question is, it is a debatable question. It is one that requires a lot of detailed discussion, and I will leave it for a time when I specifically address that particular aspect of Islamic finance.
Excellent. Thank you, Dr. Mahmoud. And to the poser of that question, I won't reveal your name because it was a private question to myself.
Mm.
You can join in future finance webinars. So we will be posting all the topics and everything. So please keep an eye out, and we'll be sending out direct emails as well with the upcoming ones. We've got one more question here. It is nearly 12 o'clock. So one more question. Does takaful fall under Islamic finance area since it is not based on buy and sale contracts?
Absolutely, it does fall into that because the scholars have held that conventional insurance largely, I'm not saying all of it, but a lot of conventional insurance is based on the concept of gharar and maisir. Now, these are two, I'm using these terms because they refer to gambling and they refer to uncertainty, which I'll cover in the next one. Yes, definitely, it is a very large part of the Islamic finance industry, and it is gaining a lot of momentum outside Australia. Of course, having said that, not all types of insurance is prohibited. For example, uh, um, medical insurance. Now, there are a lot of legal maxims in Islamic finance where the maxim says that do not put yourself in a position where you will expose yourself to extreme risk. In other words, if you put yourself in a position where you're going to incur some type of a loss as a result of not being insured, then you are doing a disservice to yourself in the sense that you will be economically less endowed. In other words, if you don't insure yourself against a hospital cover, and you do go into a hospital and it costs you $100,000 to $200,000. Now, in those circumstances, you don't have the funds. Where do you get the funds? That the question we can pose. So these are type of issues where, again, let's come to the legal maxim, uh, necessity makes the unlawful lawful in certain circumstances, and these are one of the few instances where that legal maxim applies.
Thank you, Dr. Rayhan. I'm just going to ask, does that answer your question? Are you happy with that? Oh, good. I think I'm sure if they do have questions, they can send us. Yeah, excellent. So if there are questions, please send it to site@unisa.edu.au and I'll forward it on to Dr. Mahmood, who will reply to you with your questions. As you can see, we've got 2 more webinars that are coming up. Please stay tuned and join us. This session is recorded, so the slides will be in there. So we won't be sharing the slides separately, Dr. Mahmood, I think.
I will send you the slides, because there are a few changes that I made to these slides here. So I'll give you the updated slide. But I also want to say very, very quickly, look, my intention is to explain Islamic finance to you bit by bit in small chunks. Because you can understand, you know, if the dam wall is broken, all of us will sort of be swallowed by the flood.
Yeah.
So we'll do it in small trickles. You know,
all right.
and
thank you, Doctor. I'm sorry, I've got one more question here. I think people are 12 o'clock and people have got other commitments.
Yeah.
Thank you, Shazia. The question is, if we use credit cards and ensure we make our payment due date so as to avoid incurring interest charges, is based on agreeing to interest. Are we allowed to use credit card in such a case?
Mufti Taqi Osmani, who is one of the pioneers in Islamic finance, has specifically commented on that, and you said yes, provided you don't use a credit card as a means of financing. In other words, your intention must be, this is something of convenience. Our society is becoming progressively cashless. And I think there will come a time, probably in the next 5 or 10 years, where cash would no more be available. Now, what do we do then? We have to use these cards. But if we use a card as a means of financing, knowing that interest will be charged, then we need to examine our intention. If you use the credit card simply as a means of convenience, go and buy whatever you want to, but then you make absolutely sure that you settle the payment before due date so as not to incur the interest charge. Yes, of course, that's perfectly allowed. And of course, the Islamic banks throughout the world now use credit cards extensively in their operations. But they also mention that if you don't make a payment on time, that they will charge you what we call a default charge. There's been a lot of dispute about that aspect of Islamic finance. I will get to that in future lectures, but you should understand that if you use it as a means of convenience, yes. If you use it specifically as a means of financing because you don't have the money, then the intention is not correct.
Thank you, Prof, and thank you, Shazia, for the question. I think we'll take one last one and we'll have to end here. If you do have questions, please email it to us. Last question. I think more people are interested to know if the institutions offering Sharia compliant home loans are correct or not.
Oh, this is a fantastic one, and I'm honestly hoping to spend a lot of time on this. Whoever the questioner is, please, if you can just hold on until we get to that week. I want to actually cover it in 2 or 3 sessions because it's been something that's asked to me. Would you believe? Sometimes even coming out of the mosque after Fajr prayer, somebody stops me and asks me that question. So it is a question that's been asked over and over again. I don't want to do a disservice to the providers of those home loan providers. I have to be very careful because, of course, if I say something which is not correct, then they have all the right to, you know, slap me on the hand. But yes, we will discuss it, inshallah, and we'll discuss it in detail. And I hope by then you should have a very, very good idea of what this whole financing scheme about. My plan is simply this: understand the fundamentals first. Because if you understand the fundamentals, then you will understand the methodology that they use in their financing models. But if you don't understand the fundamentals, it's going to be quite difficult to then sort of imagine what this whole idea of Islamic finance is all about.
Thank you. Jazakallah, and thank you everyone for staying for this long for the questions and answers. This has been recorded and it will be uploaded to our YouTube channel. So find us on YouTube, Center for Islamic Thought and Education, and you will be able to see other webinars and recordings there as well. So thank you. Have a lovely evening. See you next time.
Jazakallah, Ramila, and Jazakallah to all of you. Inshallah, hopefully in the next 2 weeks, I will continue with this series. Assalamu alaikum.